Right now, somewhere in the world, a government is issuing bonds. Investors buy them, collect interest, get their principal back at maturity. A nation signs a piece of paper. Money moves. The market believes that signature. This belief stands on precisely engineered infrastructure: central banks, debt management systems, disclosure requirements, insider trading prohibitions. This order is so self-evident that no one questions it. But the first place this system's ink dried was a state project with corruption built into the blueprint. 300 years ago, a nation used sovereign power to construct an enormous gambling table. The table collapsed, and on its wreckage, today's financial order was built. In 1711, Britain was effectively bankrupt. The War of Spanish Succession, 13 years, 1701 to 1714. When the war ended, what remained was not territory. It was a national debt of £50 million, an amount that would take 50 years to repay, even if every pound of annual tax revenue was directed toward it. Interest payments alone consumed a significant portion of the national budget. The government could not pay its creditors. Creditors could not sell the bonds on open markets. Bonds circulated through London at 70 to 80% of face value. Military promissory notes were near worthless. The collapse of national credit was not an abstract problem. Soldiers' wages went unpaid. Suppliers went bankrupt. London's financial district shook. Paper was already losing its value. Chancellor Robert Harley found a different solution: not repaying the debt, erasing it. In 1711, he incorporated a single company, the South Sea Company. The structure was precise. The proposal to bondholders was direct: exchange government bonds for company shares. The government would pay interest on its debt to the company. The company would distribute that interest as dividends to shareholders. For the government, debt handled without immediate cash repayment. For creditors, illiquid bonds transformed into shares, tradable on the exchange every day. Nothing real was created. Debt was erased on ledgers, national obligations replaced by the expected value of private shares, and all of it done in ink alone. Contracts, share certificates, parliamentary bills, royal charters, the moment ink first touched paper. But the company needed a story, a justification for profit. Government interest alone was insufficient, so they led with the monopoly on Spanish-American trade, the Asiento, the exclusive right to supply enslaved people to Spanish colonies. They circulated the narrative: one day, South American gold and silver would pour into London. The public bought the imagination. But across the entire 30-year monopoly period, the South Sea Company dispatched just 7 annual trading ships. Diplomatic friction with Spain meant assets were seized repeatedly. Arctic whaling was attempted. 8 years. A net loss of £177,000. The South Sea in the company's name was a market that did not exist. The monopoly's very subject was a phantom. Ink touched paper, but what that ink wrote were promises without numbers. Wordless guarantees spreading across more and more pages. In 1719, the South Sea Company arrived at Parliament with a larger plan: convert the entire £31.5 million, 80% of Britain's national debt, into South Sea Company shares. There was a competitor: the Bank of England. 2 institutions entered an open bid for the right to absorb the national debt. The Bank of England offered £5 million to the government. The South Sea Company offered $7.5 million. But the real contest was not settled by numbers. It was settled by envelopes. The parliamentary investigation later uncovered total bribes worth £1.25 million in phantom shares. The mechanism was this: enter shares on the ledger under a politician's name. No actual payment required. When the price rises, collect only the difference in cash. Chancellor John Aislabie was guaranteed £200 in profit for every single pound the share price increased. The beneficiary list included Privy Council members, royal figures, ministers of state. 462 members of Parliament held South Sea Company shares. That is 83% of the 558 seats in the House of Commons. The moment those tasked with making law became participants in the gambling table, every eye watching the market vanished. In April 1720, Parliament passed the South Sea Act. Ink began to spread. That same year, across the English Channel, France was running an identical experiment. The Mississippi Company, designed by Scottish economist John Law, same structure, national debt converted to shares, colonial trade monopoly as the selling point. But the system was fundamentally different. Britain's South Sea Company was required to pass through Parliament. Opposition voices could be heard. A post-collapse investigation committee could produce records. France's Mississippi Company moved solely by royal decree. John Law consolidated currency issuance, tax collection, national debt management, and colonial trade rights under a single corporation. The monarchy guaranteed it. The monarchy enforced it. The monarchy banned metallic currency by decree. No institution existed to check it. Same greed, different system. Both bubbles collapsed the same year. But what emerged from the wreckage was not the same. Britain produced regulation. France avoided finance altogether. The same collapse, but a system that records accountability publicly builds rules. A system that handles accountability within power leaves distrust. January 1720. South Sea Company shares, £128. March. The bill passed the Commons, £330. May. £550. June. Passed £1,050, more than 8 times over in 6 months. The annual wage of a skilled artisan at the time was £35 to £40. Buying a single share required 25 years of unbroken labor. People entered the market anyway. The South Sea Company offered a deal. Pay just 10 to 20% up front. The rest could be settled later. Leverage became available. Those without capital could borrow and buy. Maids, coachmen, rural clergymen, elderly women, noblemen. The women of Drury Lane arrived by carriage to the exchange. The records say so. King George I had been governor of the South Sea Company since 1718. There was no visible reason to view an investment backed by the king as dangerous. London became a city-wide exchange. As the South Sea Company's price soared, imitators multiplied. Between 190 and 200 ghost companies flooded the market in the first half of 1720. Companies incorporated without a single page of business plan. A company promising to build a perpetual motion machine raised £1 million. Investors queued for a machine designed to violate the laws of physics. A company to desalinate seawater. A company to extract silver from lead. A company to manufacture wooden planks from sawdust. A company offering insurance on horses' lifespans. Absurd ventures sold out within days of launch. One case among them earned a name in history. July 1720. A temporary office on Cornhill, London. An unnamed individual distributed an investment prospectus. Capital sought? £500,000. Subscription fee, £2 per share. Projected profit, £100 per share. And the business description? Do not ask. The idea is too innovative. Confidentiality is required. The office opened at 9 in the morning. Investors crowded in. 1,000 shares subscribed. 6 hours. The fraudster packed £2,000 into a bag. That evening, crossed the Thames, disappeared into the continent, never returned. The business description was never disclosed. Isaac Newton discovered universal gravitation. He solved planetary orbits in equations, analyzed the spectrum of light, the greatest intellect of the 18th century. He also bought South Sea Company shares. April 1720. He exited, intelligently. Full position sold. 100% profit realized. A rational assessment of market overheating. But after he sold, the price kept rising. May, £550. June, £1,050. Everyone around him kept getting richer. Newton could not hold. He liquidated the safe assets he had sold a month earlier and bought South Sea shares again, at the peak. In August, he participated in the peak price rights offering. September, the price began to collapse. He bought more on the way down. Final losses? A minimum of £10,000, as much as £20,000. £20,000 was the amount a common laborer would earn if they worked for 1,000 years and spent nothing. Newton later said, "I can calculate the movement of stars, but not the madness of men." The intellect that once beat the market returned to it and knelt. What this episode teaches is not that ignorant crowds are irrational, but that rationality itself collapses inside the crowd. The irony is that the South Sea Company accelerated its own destruction. It disliked investment capital dispersing into 190 ghost companies. It wanted to monopolize capital. June 1720. The South Sea Company pressured Parliament into passing the Bubble Act. Every joint stock company established without royal charter declared illegal. Surface? Investor protection. Reality? Elimination of competition. When the law took effect, more than 80 companies were forcibly dissolved. But investors had purchased those company shares, using money borrowed against South Sea shares as collateral. When the companies collapsed, the collateral value vanished. Creditors issued margin calls. To raise cash, investors had to sell whatever could be sold. South Sea shares flooded the market. End of August, £775. September 24th. The company's primary bank declared a bank run. Payments stopped. October, £290. December, £124. The share price that had been £128 in January came full circle after 1 year. In the interval, 9 out of 10 investors lost their fortunes. A secret parliamentary investigation committee was convened. Chancellor John Aislabie was imprisoned in the Tower of London following the investigation. The entire assets of all 33 South Sea directors were seized. Total confiscated, approximately £2 million. Against the full losses suffered by investors, this did not reach even 1/10. Robert Knight, the treasurer who executed the bribery campaign, fled abroad. John Blunt, who designed the South Sea Company, had his assets confiscated. Punishment was delivered. But the losses did not return. The debt remained. The investors' bankruptcies remained. And on those ashes, someone was preparing fresh ink. Robert Walpole. He had bought South Sea shares before the crisis, realized profit, and exited early. Immediately after the crisis, he presented himself in Parliament as the rescuer. He proposed a recovery plan. a substantial portion of the South Sea Company's national debt holdings to be absorbed by the Bank of England and the East India Company. The Bank of England had lost the initial national debt bid against the South Sea Company, but after the South Sea Company self-destructed, national debt management effectively transferred to the Bank of England. The institution that lost the bid obtained the monopoly after its competitor collapsed. In 1721, Walpole assumed the position of First Lord of the Treasury, the office now recognized as Britain's first Prime Minister. Those who designed the crisis went to prison. Those who managed the aftermath obtained power. Those who wrote fresh ink over the wreckage rebuilt the system. The South Sea Company continued to exist after that, maintaining its name nominally until 1853. 133 years. An empty shell. Its actual functions had long since been absorbed by other institutions. The Bubble Act was maintained from 1720 to 1825, 105 years. No joint stock company could be incorporated without a royal charter. One fraud and a century of innovation was institutionally restrained. When the Industrial Revolution began, British companies struggled to raise capital through shares. They were forced to rely on partnerships and personal credit. The rule designed to prevent the bubble suppressed growth alongside it. France paid a different price. After the Mississippi Company collapsed, France avoided the very words financial innovation. 80 years to establish a central bank. The Banque de France was founded only in 1800. That gap deepened the monarchy's chronic fiscal crises and became one of the conditions for the French Revolution. Same greed, same shock, different system, different outcome. Britain took 100 years to acknowledge that its regulatory inheritance was simultaneously its constraint. Ink dries, stains remain. Those stains became today's rules: disclosure requirements, insider trading prohibitions, securities law, central bank oversight. The principle of asset seizure applied to South Sea directors was the seed of modern securities law. The act of recruiting investors with opaque business descriptions became the basis of today's disclosure obligations. The structure of Parliament captured by a corporation etched the necessity of independent financial oversight into history. The Bank of England survived that event and has endured for 300 years to the present. It operates as the backbone of the British government bond market. Current British national debt: approximately £2.7 trillion, a number running on the system created by the £50 million debt of 1720. A design that incorporated corruption became today's financial infrastructure. It was a state-guaranteed gamble. Some were punished, the bubble deflated, but the form of the signature survived. Parliamentary oversight, central bank, disclosure obligations, devices built to prevent collapse. And the world still runs on those devices. Greed manufactured the illusion. Collapse left the rules. Rules drive the order. What does the ink drying today leave behind?